VC is not PE, different investment mindsets. So look, I'll start this off with a question, which is venture capital is not private equity. So the big question is, given that they are different asset classes, why are VC funds run so much like private equity funds? Just the background for those of you who don't know me, I've spent the past 20 years as an entrepreneur, angel, ran an accelerator. I'm a very data-driven person. I see we have an ex-McKinsey person on the call here. I'm ex-Spain myself, NCAD MBA. My undergrad was engineering physics. But really, I'm a founder of Loyal VC, and we decided to approach VC quite differently with a gate stage, or you can call it a poker process, broad diversification, and an open-ended fund. And these are fairly unusual things. So I wanted to just share some of the thinking that we went through over the 20 plus years of coming to this approach to venture capital. And the first thing which most people acknowledge and recognize, is if you look at the math of venture capital is very much an outliers business. You make half of all your money from 4% of your deals. In fact, there's a breakdown here, which is 50% of your deals, half of all checks venture capitalists write, fail completely. They don't get a penny back. The next 46% of deals, you end up making your money back. And this is the likelihood of distribution there. And you can see where the money is made in this chart on the right-hand side. You're going to make about a 2x total on average across a venture capital asset class. And half of that money comes from the 4% of deals which return more than 10x. So this is fairly well known. Everyone says it's a home run business. Not many people actually put the numbers on it to say 4%, 1 in 25 investments is a home run, but everyone knows it's about making money from home runs. They talk about the power law. Now let's compare this for a second to private equity. Private equity is a very different business. This industry is about doing well on average. And in fact, you will notice in private equity, first of all, I want to emphasize it is about avoiding failure. Only 8% of VC deals will fail completely. But what is really interesting is 2/3 of your returns come from the large number of deals which give you back between 1 to 5 times your money. And if you look at the total portfolio return, which is around the same 2x, you're going to see that 1.25x comes from these 1 to 5x return businesses. So it's very much about the average, not about the outliers. Outliers really are, they're less than 10% of the value to private equity deals. So if you think about it, these are two very different kinds of businesses. Private equity is about dealing with existing businesses, and it's all about optimization. You optimize the average deal, you optimize these modest successes because that's where your money is made. And you may not think of a 3x as a modest success. In venture terms, it's a modest success, but to private equity, that's your bread and butter. Buy a company, triple the value, sell it. And you want to minimize your losses. Venture capital is dealing very much with new businesses rather than existing businesses. This business is all about finding the outliers. Your modest successes almost don't count. And I mean, we can drill down on it. They do count. They're half your returns, but half is from the outliers. But you really need to accept your losses. Now, look, all companies go through a phase. They start in a creation period when they are incomplete in some way. They'll launch, they grow, but it's during this creation period, companies are incomplete when it comes to product, customers, or team. One of those is missing. And when you enter the sort of the mature phase where a company actually exists and you move to the optimization of PE, you've got a company here which has an existing product, existing customers, and an existing team. Now, PE may swap out the management team, but the core workers, the ones who do the day-to-day work, already exist. And then the companies, often PE, will either grow an already successful business or they'll come into distressed businesses, turn them around, and grow them again. So the big question here I started off with is to say, why does venture capital adopt common private equity strategies? And look, if you look at the two asset classes, VC has copied a lot of standard PE strategies as default. So for instance, your standard fund size in either PE or venture capital is 10 to 15 investments. If you look at how they control those deals, it's very much about having tight control. You always want to have a big enough holding that you can sit on the board. And what's the point of sitting on a board? Well, the point of sitting on a board is that you can swap out the CEO if they don't perform. Boards give nudges on strategy. They give nudges. They provide sort of supervision, good governance. But fundamentally, when it comes to changing the business, it's all done by swapping out the CEO. So that's why you want to be on the board. If you look at how they run their businesses, both PE and venture capital are very analytic heavy businesses. Now, PE may be more analytic in how they look at deals, but in either case, they pride themselves on analyzing 200 different deals for every one you do. In a worst case, you do 1 in 100, and then you're considered to be not a very selective fund, and really it's the 1 in 200. If you look at the deal terms, it's all about protecting the downside. It's all about saying, can I have preference shares? Can I have sort of chances to get my money back, preferential liquidation treatment, even preferential payouts before other people get paid, because you really want to keep that downside protected. And lastly, the fund life, everyone does. It's sort of a closed-ended, typically an 8-year fund with extensions. Sometimes PE is a few years shorter, but this is sort of what this looks like. Now, the question is, do these make sense as VCs? As a VC, and I'll just run through each of these. If you look at the fund size, if you have 10 to 15 deals, you've got less than one home run per fund, because we know it takes 25 deals to get a home run. So does this make sense? You're talking about control and swapping out CEOs. Well, when you're the early growth stage of a company, are the CEOs really replaceable? Replacing a manager is very different than replacing someone who's creating a business from scratch. When we talk about analysis, well, when you're analyzing things which are incomplete, let's be blunt, you're guessing. Deal terms, why are we protecting the downside? We know in venture capital is about optimizing the home runs, not the downside. And the fund life, while a fixed 8-year timeline makes a lot of sense when you're buying an existing business, optimizing and selling it. But if the business doesn't exist, if it's still being created, if important elements are incomplete, doesn't that have an unpredictable timeline? So we sort of look at this ourselves, but if you run the math very quickly, and you remember that in PE, it's the average deals that make money. If you have 15 investments, 64% of those are those average deals, the ones where you predictably make most of your money. And that gives you 10 deals out the other end. So you make 15 investments, you end up with 10 holdings, a fairly diversified group across which your success is spread. If you want to talk about venture capital for a second, to get the same 10 deals at a 4% probability, you need to start with 250 investments. So if you want to get predictable results to the same predictability as private equity, you're talking about an order of magnitude different investments. Now, we do this, we believe in this. We've got over 300 investments in our portfolio. And we diversify because it's about de-risking. But just generally speaking, think very hard about that magic number of 250 to match what a PE gets from 15 deals. Now, the big question, of course, you're going to have when you look at this is, how do you operate at scale? The reason PE companies do this is because you want to have basically one partner for every 5 deals. If you're talking about having 250 investments, you're talking about having 50 partners. It gets really challenging. And the way we do it and the way we operate at scale, because to deal with the practical question right away, is we separate the advising from the investing. We have a proprietary network of over 1,000 people to support our entrepreneurs, 800 advisors, 300 fellow portfolio companies. But the real point here is to say, managing an investment and advising the companies can be done by two different people. And the second you separate those two apart, you can then start to scale up your operations if you scale up the number of advisors that you have. Some of you will have seen this already, but I just wanted to bring out here that there's an unpredictable element. There's an unpredictable element to venture capital. Private equity, it's about making the average thing work well over and over and over. 2/3 of the time you follow your playbook and you get exactly the results you expect. It's very much like cooking. You swap out the top management, you bring in people you know already who know how to drive operations, who know how to drive marketing, sales, etc. And you should get a predictable outcome with the profits increasing, etc. Venture capital, we believe, is very much like poker, where your outcomes are unpredictable. You start off with hands, and some hands may look better than others, but you have no idea what's going to happen over time, how markets will evolve, how key team members will act, and you can actually see companies you weren't sure would perform can be the top companies or can be the worst companies. So this is the way we invest, which is exactly the same way you're used to seeing poker players invest, which is a small amount of money initially just to see the cards. We do 6 investments every month at the top, at the $10,000 level, and then play a minority of those hands further based on how things develop over time. And that's our view: small ante to see the cards, and then if they're looking encouraging, put in more over time as you see the story develop fully. And poker players, you make most of your money by deploying more money into the very top performers. That exactly is what we do, with most of our money being deployed to the top performers. And this has been working very well for us, which is, you can see our returns from the follow-on investments are 27%. The returns from the initial investments are 8%. Now, I just want to stop and pause here for a second, because this outcome is very, very different from the industry wisdom. So there was an article out just a few months ago from a group called Moonfire, who had analyzed they were basically running scenario AI analysis of different VC portfolios. And they said, look, how do you want to design the optimal venture portfolio? The short answer is, don't do follow-ons. Deploy all of your money in the first checks. And the reason why, and Loyal does relationship-based investing. You get to know the companies over time, you have more knowledge. That gives you a chance to see when companies are doing well. But you also build up a relationship with those companies over time, so that when they are doing well, you have potential access to put in more money. The upside is you've got the relationship. It's easier to get the entrepreneur to take your money. The downside is you have the relationship and you are tempted to invest for reasons other than pure financial. Most VCs, their returns from their follow-on investments are about the same as the returns from the initial checks. And if you listen to VCs talking about why they do follow-on investments, they talk about things like protecting their investment, giving the company a chance to grow. When you talk about protection, when you talk about giving a chance, you're not talking about optimizing returns. You're talking about helping people out because you've got this relationship and you want to help, which is why Loyal follows this very strict rule of only doing the top 2% of the companies in our portfolio every month. It is emotionally really challenging to do that because you want every company to succeed. Financially, as an investor, it's a very profitable approach, and we believe is what allows us to outperform. If you're going to do a strategy like this sort of multi-stage process, if you look, and this really talks the unpredictability, if you look at companies moving from one stage to the next with Loyal, it takes companies anywhere from 3 or 4 months up to 25 to 40 months to move on to the next stage. If you talk about doing that over 4 stages the way we do, you could have an investing period which is 5 to 10 years long. And if you've got an investing period which is 5 to 10 years long, you cannot do that from a closed-ended fund because you just finished deploying and you have to sell all the assets, which is why we run an open-ended fund. If you're an open-ended fund, then you really want to look at doing quarterly pricing liquidity. Now, there's a lot of people out there talking about evergreen funds, and an evergreen fund just means you put your money in, you can never take it out. The joy about an open-ended fund is you put your money in, and when you take it out is open, you get to choose. So we did that. We do a quarterly liquidity. If you do that, you have to do quarterly pricing. And that is really where the challenge is. Happy to talk about pricing if people are interested in that. So if we circle back to the original question, venture capital is not private equity. So why are VC funds run like PE funds? Well, we know what the default sort of PE and venture capital strategy is. Here's an alternative strategy to use in venture. Standard fund size is 10 to 15 deals. Why not have a fund size of 250 deals to get 10 predictable winners rather than just sort of 10 average returns here? Talk about control, where people talk about tight control and swapping out the CEOs where they underperform. You can't really, our belief is you can't swap out founders. Founders bring so much to the company. And if you can't swap someone out, you can't control them. All you can do is advise them. So we believe it's really good to give people access to the best possible advice. If a company is underperforming, we're not going to try to fix it and turn it around by bringing in new management. We have sort of a passive cutting our losses by not putting more money into companies until they perform. It's a very patient approach, but it's similar to the poker approach. Only the nice thing, the difference between investing and poker is in poker, you have to decide if you put more money in, you have to throw the hand in. In our case, you can decide to put more money in. In between, you can simply hold all the other hands, which look like they may lose, for the small probability that those things which look like they're doing poorly now turn around and succeed later. And there's a number of famous stories in the investing world, such as Airbnb, of companies that initially looked like hopeless causes, which over multiple years figured it out. In fact, the example I always love is BlackBerry, a Canadian example, which took 10 years from their first when they launched the company to getting their first venture capital. So we like to sort of sit there and have time play on our side. We talked about analysis, analyzing 200 deals to do one. I mean, in poker, you can analyze your first 2 cards all you want, but there's only so much analysis you can do until you see how the plan and the hand plays out. So we prefer to place many small bets and then react to how things develop over time. Deal terms, look, PE and VC are all about protecting the downside. We know that we make our money predominantly from the winners, so why focus on getting preferences to get clawback money on failures? And I mean, there's a moral aspect for us, which is why take the money out of the hands of the entrepreneur who struggled for years on a small sale? But the upside is you make your money on the winners. You have common shares as the best possible way to do that. Everyone shares. And if someone is giving you common shares, then that helps protect the entrepreneur. You should see a better price for common shares than you do for preferred shares. And lastly, we've talked about the timelines. We're an open-ended fund because if you want to sort of build those relationships, invest based on performance over multiple years in emerging companies, you have to give them time to succeed. And that time works best when you don't have the investor jumping up and down saying, fix it now, grow now, so I can sell and move on with my business. So let's stop there, and happy to take any questions that you have. So, any questions? I don't know if this is a very clear approach. I don't know how many people have thought about why venture capital funds are structured like PE funds, and if that really makes sense.
more talking about, hi, Kamal, James here.
Yes.
I'm quite curious, so more in terms of that, the comparison between PEs and VCs. Do you see that there's a certain movement of investors, people who would have been at some point on more focused on PE, moving towards more of a VC investment, or the other way around? Is there any shift, because there's certain similarities in those type of companies, those the VCs who follow a bit the PE model? Do you see that they move, or they tend to stay?
So there's a strong structural incentive in venture capital to deploy larger and larger amounts of money, because you receive a management fee on the money 2% of the money you manage, and you'd much rather have 2% of $3 billion than 2% of 30 million. Just sort of common sense. So the result is, what happens in this industry, if you're good at venture capital and you make money in your first couple of funds, good or lucky, we will let the jury be out on whether it is skill or luck. But if you are good or lucky, it is economically irrational not to want to manage more and larger amounts of money. Actually, our structure, the way we set up our fund, is actually structured in order to naturally take in and manage larger and larger amounts of money over time, because we do these multiple stages with larger and larger checks. So our view is that the fund will grow over time in parallel to our entrepreneurs. We are both going to be growing together. So as some of our entrepreneurs mature and need larger and larger amounts, we will be more and more capable of providing them. But what happens normally is people just sort of say, hey, I don't want to keep managing the same relationships. I'm going to do in a larger fund. And as I do a larger fund, I'm going to be investing in companies that are more mature. And as companies are more mature, it looks more and more like private equity, because it's a mature company. Things are known, things are predictable. And there's really this gray zone. So what you see happening from the manager point of view is managers start small, succeed, bigger fund. If they fail, they probably just leave the industry altogether. So it's a continual flow of new venture managers. You don't really have experienced people in venture who do small checks for long periods of time. They grow, they become more like private equity. So that's from the manager side. You push up the scale. From the manager side also, look, private equity is often considered boring industrial companies. So lots of private equity funds try to dip into the larger, later stage venture scale. So you get this mismatch, mix up where you've got these two people, private equity and venture capital, both growing into each other and sort of managing a little bit like each other and bringing a little bit in there. So you do see the movement the other way from private equity to large scale growth venture, because they're sexier stories, they're easier to raise money on. If you think about from the investor point of view, there's some really interesting data out recently, which is that if you look just at the past 1 year period, when markets have been down dramatically, venture capital valuations have dropped significantly in the growth stages. And many people are saying seed stage valuations have been staying fairly constant. Now, that is industry-wide data. We're seeing, what we're seeing in our portfolio, this is a joke in VC right now, but it's, as all jokes with a basis of truth. And the joke is that a flat round is the new up round. So people are tending to raise, if they succeed, they raise at the same valuation they raised at last time. So you're seeing, I think, valuations partly holding up on a statistical basis based on that phenomenon. But it is true that if you looked 3 years ago, growth capital was very oversupplied. And in fact, there's always been more money, bigger managers trying to deploy large checks into companies at that growth stage. And early stage venture capital has always been undersupplied by capital. And you can look at the number of companies and the amount of capital, the number of deals done versus the number of companies at each stage. And of course, you can see companies fall off, the number of companies fall off per stage, because many companies fail at those early stages. But the number of deals done was roughly the same, which doesn't make a lot of sense. How is it that you have the same number of seed stage deals as you do Series B deals, you should have a quarter as many Series B as you have seed stage, because a bunch of the seed stage are going to fail. So it's always been undersupplied by capital. So early stage venture has always been undersupplied with capital and is typically always on aggregate had higher returns than other stages. So I think some investors recognize that. The challenge is you move into early stage venture, you do a 15 company portfolio, it's highly risky, and then you do a few VC deals, you either make a ton of money, you think the asset class is great, you do it, or you do a few funds, you lose all your money, you go, this asset class sucks. So I think there is always this desire on the investor side to move into venture capital, to look at the earlier stage investing. But it's always challenging for them to look at that and say, am I ready for this? Or they go in and they hit things they don't expect and they write the asset class off as low risk. And it's not, this asset class is like any other. You can invest in a high risk or a low risk manner. It's just most funds run in a high risk manner. And people think the individual assets are risky, just like individual stocks are risky. The funds are risky because they run in a risky manner. But if you run professionally and run with enough volume, it's actually, you can dramatically reduce the risk. And it's a very interesting asset class from there. Does that answer the question?
Great. Yeah, thanks.
Perfect. Neeti, go ahead.
Thank you, Kamal. So there's a question, we normally face that, especially from the portfolio companies. One is, do they really need to go in for a PE at some point of time in their growth journey? And if yes, necessarily, then when?
So for companies, the absolute best way to fund your company, and it's very old-fashioned, is off of sales and profits. The more you can not need outside capital to raise, the better, and then you can use outside capital strategically. So, I mean, it's the good old paradox, I mean, the joke about the banks, and it applies to an extent to venture capital also, and to all investors, is banks will only lend money to people who don't need it. And it is very much the same, that the more you can prove that your company is doing well and will grow to profitability without the money, the more interested the investor is to invest, as a general rule. Now, of course, it's all, we're a very price conscious investor. Many others are not. We understand, I mean, Helmut was saying earlier that this is a simple business. You buy low, you sell high. That's what venture capital is. We're just a trading business. So we are very conscious of, you have to buy low. There are many people who say, if you're going to exit for $1 billion, who cares what price you pay when you buy? And it's all about finding that $1 billion company, and you pay any price you can when you're on the $1 billion company. We don't trust ourselves to be able to predict which one of the many stories we see are $1 billion companies, probably because, I mean, my own personal experience, I've spent 20 years as an entrepreneur, 15 years angel investing, but also I've advised hundreds of companies through the Founder Institute, through other places. And I've seen the companies I thought would succeed sometimes do and sometimes fail. And the companies I would fail, some small number of those succeed. So I've learned that I can't predict things, and therefore I'm not going to buy at any price because I'm sure it's $1 billion company, because I know I can never be sure it's $1 billion company. So therefore I want to buy low and sell high on average. So yeah, returning to the question, should you go for PE? Look, I think you should run a profitable business, and then you should consider your options at any state where you are with that business, and be able to consider those options with as little pressure as possible. The example I love is the Australian business, and their name will come back to me in a second, Jira. Jira managed to grow their business to, they basically started their business on a credit card, funded everything on customer sales, and then they finally, I think 8 years later, did a $50 million venture PE type round to be able to grow more quickly, build out their sales in the US very quickly, et cetera. But they did that very strategically as a next step before a public listing because they knew they could. And I think that's the best way to do it. Don't don't feel forced to grow when you're not ready. And when you think you are ready and you're ready because your business shows it's ready, then yeah, raise money.
Thank you.
Question here. There was a question there from Jean-Lee. Jean-Lee, it's sort of disappeared. Did you want to ask the question or? There we are. Yes. Jean-Lee asks, when deciding on which startup to follow on in, how much do you consider the impact your follow-up can have on the future performance of the company versus a pure valuation multiple? And this is a really good question, Jean-Lee, and it comes back to the sort of the relationship aspect of investing, which is it feels really good as a person to know that your investment has a massive impact on a company. That's about feeling. Is it, if you want to make money, then the impact your money has on the business is really a secondary factor, because really, I mean, the primary factor is this the most profitable investment? Are you going to, is the multiple you make when you invest in this money going to have the most difference? And most VCs out there absolutely do think about impact. Most VCs, especially on their follow-on investments, are really thinking about helping out somebody they've already made a massive commitment to. And I know it sounds extremely hard-hearted. The reason we have done well as a fund so far is because we decide on the follow-ons. We only have a limited number of follow-ons. And when you can say, here's a company that needs the money less, where you have a massive impact, and here's a company that needs the money less, so you have less impact, but it's got a massive potential return. The risk-adjusted return profile looks much better than a second company, which really, really needs it, where the risk-adjusted return doesn't look as good. You know, generally, I mean, in our case, we just picked the best return. Now there are, we're in relationships with companies. I don't want to say we never do it. We always, at the margin, are going to look at factors like that, but that's very much at the margin. It's not the primary things that drives us. The primary thing driving us is returns. And our fund is set up that way with large steps between each round, so that when you're writing a larger check, how much you have at stake in the earlier rounds has relatively little impact, because the next stage check is so much larger. Now, if you do well, we're an amazing fund to work with. We try to help everyone, whether we give them money, and that's sort of the flip side of the sort of psychic contract we have with the entrepreneurs, is we do care about them, we want to help them. It's just the one day in the month when we allocate capital, we become very hard-nosed capitalists rather than the friendly, supportive people who are rooting for your success and do everything they can for it. And most people write checks when they say do everything they can to help you out. And we will do everything short of writing a check ourselves, including referring you to and giving recommendations to other investors on your behalf if needed, because we want you to succeed. Good. Any other questions? I notice a couple of people have showed up late. I'll just pull up that last slide there for those who've showed up late to sort of see the core of the talk, which was why are VC funds run like PE funds with similar fund size, control mechanisms, analysis, deal terms, and fund life when it's very different types of investments. So, any other questions? I don't know if any people on the call have invested in other VC funds and asked those VC funds these types of questions. Curious if you have what those other VC funds say about why they adopt the standard strategy. Good. We're happy to wrap this up quickly if there are no further questions, but I'll just leave it open for any last chances anyone else who may want to ask. I noticed there's a couple of entrepreneurs on the call. Do any of the entrepreneurs have questions about the approach and why we do it this way, and or any comments on what it's like dealing with an investor who works in this way? How does it feel to be on the other end of this?
Yeah, hi, Kamal. This is Miguel. I'm one of the portfolio companies, and the reason why I was interested in this call is because we do get, and I'm sure it's the same for other portfolio companies, like we do get pinged a lot by private equity, by PE companies, and somehow when you talk to them, it never quite makes sense. Like they do have a very different mindset, and I was just trying to wrap my head around that. So yeah, I mean, as always, I find it very, very refreshing, kind of like your insight on this, and like really, when you are small and when you're just really getting started in your growth strategy, then kind of like the philosophy that Loyal has is really the right way to go. And like that, my takeaway really is like, let's not waste any time really talking to PEs, because they're really the wrong partner for this stage of our growth, to put it that way.
Yeah, look, the big thing here when you're thinking about PE is this second point, which is private equity is all about taking an existing company, exercising tight control over it, and very, very frequently swapping out the top management for their own people to bring in the established people, the playbook to help you grow. So if you are ready to exit your business, then PE is a wonderful thing to do. It's a great, they can be very good acquirers to help you run. Now PE, just sort of the buy low, sell high applies exactly in PE the way it does in venture capital. So you may not get the best exit value from a PE that you would if you waited a few years and grow with the business yourself. But there's always a risk to doing that. And if you say, hey, I want to sell right now, then do, but understand that it is very much PE often also, it's not written in here, PE often insists on majority holdings. Venture capital will do minority, but the second someone buys a majority of your business, and there was a call we had yesterday with someone who were talking about how one of the companies they were dealing with had been bought by an acquirer. The acquirer bought 55% of the company, and 2 years later, they shut the company down. And you had all of these sort of investors who still had their minority holding in the company, the minority holders who weren't able to do anything about that. And they lost all control. And I would say when you're with a PE, don't buy the story of, oh, I'm buying 55%, I'm going to grow it, blah, blah, blah. When someone's acquiring control of your company, be very aware how little control you have over the future. We have another portfolio company which was acquired where the bulk of the money came in payouts over multiple years based on performance of the acquired division. And same old story, 6 months in, they were saying, well, we were supposed to get all these sales through using their sales force to sell to their existing customers, and none of those sales have happened, and their sales force isn't happening. The sales aren't happening, and the rationale isn't there. So it's another thing, if you're giving up control, really understand that anything that comes after the day somebody else controls your business, you can't count on. So cash up front as much as possible, because that you can control. Expect to be fired at a moment's notice. And if you're comfortable with all those things, because it's time to cash out of the business, then do it. Private equity is great to acquire you in that case.
Thanks.
Good. All right. If there's last chance for questions. Otherwise, okay. Thank you very much to everyone for attending. We'll stick a recording of this up for those who are interested in watching it afterwards. But thanks very much for joining. Hope this was useful, informative. You got something out of it.